Welcome to the Academy. In our last lecture, we look at some theoretical aspect of the bank reconciliation statement, and today we're going to look at the format of preparing bank reconciliation statement. So we have, let's say, the methods of preparing bank reconciliation statement. So we have one, adjusted cash book. The bank column. 2, we have the reconciliation. So we're going to adjust our cash book, then we go ahead to do our reconciliation. These are what we're going to do today, and in form of format. So let's look at the format, starting with the adjusted cash book. Adjusted cash book, we are going to adjust our bank column in the cash book. The balance in our bank column in our cash book, we are going to adjust it because the balance in the bank column of our cash book does not agree with the balance in our account in the bank. So we are going to adjust our cash book in order to allow our balance in the bank column of our cash book to agree with that of our account in the bank. So we must first of all adjust our cash book. Then the balance as per adjusted cash book will be used to prepare our reconciliation statement. Let's look at it. This is the format of the adjusted cash book. Adjusted cash book. So this is the bank column of our cash book. So don't forget, this is the extract of our bank column in the cash book. So now, since this is the extract, we are going to have our balance brought forward, your currency sign, your credit, and your debit. Please don't forget all these signs. They are very important and necessary. So this balance brought forward is the bank column balance in our cash book. That is, in practice, we are bringing it now here to make all our adjustment to this balance. So all adjustment that we're going to do will affect this balance. That is, when we are adding, it will affect this balance. That is, it will be added to this balance. And when we are lessing, it will affect this balance. So all the adjustment that we're going to do in the adjusted cash book is to affect that our bank column balance in the cash book that failed to agree with our bank account balance. So now, and if you will recall back in my last video, I listed the items in the bank statement and they are not in the cash book. And also items in the cash book which are not in the bank statement. So when you are adjusting the cash book, those items in the bank statement which are not in the cash book are those items that we're going to use to adjust our cash book. And it's like that. In a normal life situation, in our cash book, we don't have anything, we don't have those items that are in the bank account, which make the bank account not to agree, or the cash book balance not to agree with the bank account balance. So those items will be here to adjust in order to arrive at an adjusted balance of the cash book. So it's simple as that. Now, for us to do that, we will go and identify our items, those items that I listed in my last lecture, and those items will be grouped into two. That is, one, items in the bank statement that reduce the bank statement balance, comma, will also reduce the cash book balance, period. That is, those items in our bank statement that are not found in the cash book, and we are going to use these items for adjustment. The items are grouped into two. One, items in the bank statement, the items that reduce the bank statement balance will also reduce the cash book balance, because the relationship between the balance of the cash book and the balance of the account in the bank or the bank statement is a positive relationship. That is, for example, if our bank account is having a $10 and our cash book balance is $15. So you identify those items that less or that reduce our bank account balance, that is the bank statement balance, not to be $15. And if you identify those items, you will come to your cash book balance and less it, so and reduce it with this 5 so that it will be 10. So any item that reduce our bank account balance will as well come to the cash book and reduce our cash book balance. Any item that increases our bank statement balance will come to the cash book and increases the balance of our cash book. Simple as that. Okay? These items are: 1, bank charges. 2, standing order. 3, dishonored check. 4, errors. So these errors are errors in the cash book. Errors in the cash book. So these items are not in the cash book. It is only error in the cash book that will be corrected in the cash book. An error in the bank statement will be corrected in the bank statement. That is, all these items are not in the cash book, with the exception of error. I hope you're getting it. If it is bank statement, the errors in the bank statement will be used to correct our bank statement. In the cash book, the error in the cash book will be used to correct our or adjust our cash book. So these bank charges, it is the same thing as interest charges is the same. Commission, bank commission, all is the same. The examiner might choose to use bank charges in item 1 of the question, interest charges in item 2 of the question, or commission in the other item of the question, but all have the same treatment. So standing order, we can also use direct debit, and the rest. All is the same, but the examiner might choose to use different terms, standing order, just to confuse you. Direct debit is the same thing, or debit transfer. So dishonored check, bounced check, all the same, or rejected check. And error, this error is the error that will reduce our bank balance in the cash book. So the error here is 1. Payment undercast. Received overcast, and cash received. So these errors will either come in form of payment undercast. What this is telling us that you're supposed to pay high and you pay less. So you must take out the remaining amount that you're supposed to pay in full to complete it as a full payment. So it will reduce our bank balance in the cash book, because we're supposed to have made, like, let's say we're supposed to pay $20 and we pay $15. The payment is undercast. So if this payment is undercast, so you will pay out the remaining 5 to make it $20. So if you are paying the remaining $5, it will reduce the already balance that we have in our cash book. I hope you are getting it. All items here will reduce our balance, our cash book balance. And the second one is received overcast. Whenever we receive something higher than what we're supposed to receive, you must less it. So by lessing it, it will affect the balance of our cash book. Say we receive $30 and we're supposed to have received $20. So after identified the error, you will remove it. You will less this your 30 with 10 to give us 20. So received overcast, the difference, that is the error, will come to your cash book to reduce the balance already recorded higher. I hope you are getting it. Then the cash received. This is a bank column. This is a bank extract of a bank column from our cash book. And we don't record cash in the bank column. And we mistakenly record our cash, we receive it in the bank column. And it was cash. So knowing that, since we have received, we will come and remove it. We minus it by reducing this amount that we've already received to clear it off or to cancel it. So cash received, wrongly received, will reduce our balance, bank balance of the cash book. Simple as that. I hope you are following. Now, these are the items that will reduce our bank balance of the cash book or the cash book balance. So the remaining thing now is for you to come and put it so that to affect this balance of our cash book, that is the bank balance of our cash book. So let's do it. You say one, say bank charges. Bank charges. You put it. These bank charges, let's put all these other names, which I say they are all the same, but the examiner might try to test your intelligence, and let's put it, say interest charges, commission, interest charges, commission, then we go to the second item that reduces our balances, which is standing order. This whole not check. I did not explain this. This whole not check, this is a check that we received the check. We have received this check from our customer. So it has already added to the balance of our cash book since we have received and we have recorded it as a receipt. But taking it to the bank, it was rejected. So to adjust this, you must minus that dishonored check. And that is why it is here. To remove from the balance the already check that we have recorded, to remove it out, the dishonored check will be here to cancel that already check received. So it will be here. And errors, I've already explained this. So errors, say payment undercast, received overcast is the opposite. Overcast, then cash received. I've explained this. So these are the items, the standard format of adjusted cash book that's supposed to affect negatively the balance of our cash book. So here the same thing as positive, and here is the same as negative. So whatever comes in here will add to the balance, and whatever comes in here will less or reduce the balance of our cash book. That is bank column of our cash book. So these are items in the standard format that are supposed to appear in the credit side of the cash book while adjusting. And let's look at the items that are in the bank statement that increase the bank statement balance and as well will increase the cash book balance. That is the same thing, items in the bank statement that increase the bank statement balance and also increase the cash book balance. Yes. So these items. So items in the bank statement that increases the bank statement balance and also increase the cash book balance in the credit side of the bank statement. You receive a credit alert. It increases your bank account. So it will also increase your balance in the cash book. Let's see this item. 1, credit transfer. So the credit transfer is the same thing as direct credit. So 2 is interest income. So this interest income is the same as dividend and other interest that you might receive. Number 3, the arrow in the cash book. So this arrow is the opposite of this. You say payment overcast, received undercast, and cash paid. So this is very simple. Payment overcast. You pay a higher amount than you're supposed to have paid. So after knowing this, the higher amount, the amount that you pay high, you bring it and add it back to your balance because it has already affected your balance before, lessen your balance before. So you will bring that difference that you pay high and come and put it here to increase, to add up to your balance. Received undercast. This is very simple. We received less than what we should receive. So in this, after knowing that we have made a mistake of receiving less, so we will add the remaining balance to it to complete, to make it a full amount received. And cash paid. We pay out cash, and this is bank column. So it will come back here, you add it up here, that cash will come back to add up to your balance. You will cancel it, and it will come here to add up to your balance. It's very simple. So this is a standard format of adjusted cash book. So here will be credit transfer or direct credit. We use that credit transfer. Here will be interest. Then here will be, we can use dividend. They all are interest. Dividend. And the arrow, payment overcast, received or receipt, received undercast, and cash paid or payment. So this is the standard adjusted format of adjusted cash book. Now you add, you add all this and this, then you look for, you balance the account. So now you balance the account by comparing the debit side and the credit side. So in a normal business, a business that is paying, the debit side is supposed to be higher than the credit side. So if that is the case, at the end of the month, here will be our balance CD. Balance CD of, let's say, CC, and you add it up, and in the next month, which is August, using our cash book that we've prepared, August, 1st of August, will be our balance be brought down. This is the adjusted balance of the cash book column, or updated cash book balance. So this is what we have for you, and we'll continue with the bank statement